Welcome to StokTok's deep dive into ConocoPhillips. The company is one of the largest independent exploration and production companies in the world, focused on finding, producing, and selling crude oil, natural gas, and natural gas liquids. At the time of recording, shares are priced at 116, sitting meaningfully below the 52-week high of 135.87, and well above the 52-week low of 84.28. The RSI, or Relative Strength Index, a momentum measure, reads 38, edging toward oversold territory without yet triggering a technical signal. The 50-day moving average sits at 119, while the 200-day moving average is at 98.87, indicating longer-term structural support remains intact. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. ConocoPhillips operates a diversified, globally distributed upstream energy portfolio, generating revenue primarily through the extraction and sale of hydrocarbons across North America, Europe, Asia-Pacific, and the Middle East. Its competitive moat rests on low-cost reserve positions and disciplined capital allocation, a combination that has historically allowed the company to generate returns even in lower commodity price environments. The StokTok score stands at 56 out of 100, a hold signal. Valuation scores the highest at 17 out of 20, while growth and smart money each come in at 8 out of 20, dragging the composite lower. Now, valuation. The question every investor has to answer: are you paying the right price? ConocoPhillips carries a trailing price-to-earnings ratio of 18.3 times, meaning investors are paying $18.30 for every dollar of recent earnings. The forward price-to-earnings ratio drops to 14.5 times, which implies the market expects earnings to expand meaningfully from here. The PEG ratio, which adjusts the price-to-earnings multiple for growth, with readings below 1 considered attractive, sits at 0.59, suggesting the growth-adjusted valuation is compelling on a standalone basis. The EV/EBITDA multiple, a measure of enterprise value relative to operating cash generation, is 6.18 times, well below where integrated majors such as ExxonMobil or Chevron have historically traded. The GuruFocus Value, an independent intrinsic value estimate, is 104.09 at the time of recording, implying the stock trades at a premium of approximately 11% to that estimate. Wall Street analysts, at the time of recording, have a consensus mean target of 138, drawn from 27 analysts, with estimates ranging from 100 at the low end to 183 at the high end. The next earnings report is due April 30th of 2026, with the street expecting earnings per share of approximately $1.67, a meaningful catalyst to monitor. Market sentiment around ConocoPhillips, as of the creation of this video, leans neutral, with geopolitical tensions providing an indirect tailwind to energy prices, while company-specific catalysts remain sparse. In our view, the valuation is not stretched on a cash flow basis, though the premium to GuruFocus Value warrants discipline. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist that tests profitability, leverage, and operating efficiency signals, comes in at 5 out of 9 for ConocoPhillips. That is a mid-range reading. The company passes more tests than it fails, but it is not a clean bill of health across the board. The Altman Z score, a model that estimates bankruptcy risk with readings above 2.99 considered safe, sits at 3.16, firmly in safe territory, which is reassuring for long-duration holders. On the balance sheet, cash to debt is 0.3 times, meaning the company holds 30 cents of cash for every dollar of debt. That is modest coverage, and it is worth watching should commodity prices deteriorate. However, interest coverage, the ratio of operating earnings to interest expense, stands at 9.2 times, which is a genuinely comfortable buffer and suggests debt servicing is not a near-term concern. The debt-to-equity ratio is 0.36, which is conservative by energy sector standards. The current ratio, measuring short-term assets against short-term liabilities, is 1.3 times adequate but not generous. On balance, the foundation here is solid, not exceptional. Management has demonstrated measured leverage discipline, and the credit profile holds up well against stress scenarios in our view. Next up, profitability. Is this business actually making money efficiently? Return on invested capital. The return the company generates on all capital deployed, both debt and equity, stands at 6.57%. For context, a return on invested capital above the company's cost of capital is the threshold for genuine value creation. And in the energy sector, where capital expenditures are enormous, mid-single-digit return on invested capital is broadly in line with peers, though not a standout figure. The profitability score of 10 out of 20 reflects that reality. Working down the margin stack, gross margin is 25.09%, meaning roughly a quarter of revenue survives after direct production costs. Operating margin narrows to 19.24%, absorbing overhead and exploration expense. Net margin comes in at 13.55%, a healthy conversion of revenue to bottom-line earnings relative to integrated peers that carry higher refining and retail cost bases. Free cash flow margin, which measures cash remaining after capital expenditures as a share of revenue, is 12.29%. That is the figure that ultimately funds dividends, buybacks, and debt reduction. In our view, the profitability profile is adequate and demonstrates the efficiency advantages of a pure-play upstream model, but return on invested capital remaining in the mid-single digits keeps this from scoring as a high-quality compounder on profitability alone. On to growth. Is this business expanding, and at what rate? The growth picture for ConocoPhillips is the most nuanced dimension in this analysis, and it earns just 8 out of 20 on our scoring framework. Over the trailing 3 years, revenue has contracted by 9.1% in aggregate, a meaningful decline that reflects the volatility embedded in commodity-linked businesses. When oil and gas prices move, revenues follow, and the trailing 3-year window captures a period of price normalization after prior peaks. Zoom out to the trailing 5 years, however, and the picture improves considerably. 5-year revenue growth is positive 17.3%, suggesting the underlying production base and asset quality have generated real expansion over a longer arc. Book value per share has grown 10.3% over the trailing 3 years, which indicates that even as reported revenues compressed, the company was building intrinsic net worth, a sign of disciplined capital allocation and retained earnings at work. The dividend yield at the time of recording is 2.79%. For an energy producer, that yield provides a return floor and signals management's confidence in forward cash generation. However, the near-term revenue trajectory and the growth score both warrant honest acknowledgement. ConocoPhillips is a cyclical business, and investors must underwrite commodity price assumptions explicitly. The data suggests growth is real over the long run, but lumpy and heavily macro-dependent. Now let's talk smart money. What institutional capital is actually doing with this name? 23 top-tier guru investors currently hold ConocoPhillips in their disclosed portfolios, which is a meaningful signal of institutional validation. Among the most notable is Bill Nigren of Oakmark Funds, who has ConocoPhillips at 2.85% of his portfolio and added to his position by 27.24% at his last reported filing. A significant conviction add from a manager known for patient, value-oriented investing. Christopher Davis of Davis Advisors also added 12.42% to his position, bringing the name to 0.76% of his portfolio. Tweedy Brown, another deeply respected value franchise, added 5.24% to a smaller allocation. On the other side, Yakman Asset Management trimmed by 2.38%, and Dodge & Cox made a marginal reduction of 0.36%, suggesting some rebalancing at the margin, but not a decisive exit. The 13F filing data, which tracks what large institutional money managers reported to regulators, shows only 11.8% of filers are net buyers, a reading that falls well short of the 50% threshold we use as a proxy for broad institutional bullishness. That is the most cautionary signal in the smart money dimension. Insider ownership stands at 0.33%, effectively negligible. And over the last 3 months, insiders filed 0 purchases and 11 sales. Insider selling is not automatically alarming in a large-cap context, but 11 transactions with 0 offsetting buys is a pattern the data-driven investor cannot ignore. And finally, the verdict. Let's bring it all together. On valuation, the setup looks interesting to us on a free cash flow and forward earnings basis, with a PEG below 1 and an EV to EBITDA multiple below sector history. Though the modest premium to GuruFocus Value means there is limited margin of safety at current prices. On financial strength, the balance sheet is conservatively levered with comfortable interest coverage, and the Altman Z score places ConocoPhillips firmly in safe territory. On profitability, margins are solid for a pure-play upstream producer, but return on invested capital in the mid-single digits keeps the profitability score from breaking out. On growth, the trailing 3-year revenue contraction is a real concern, and investors should underwrite this name with explicit commodity price assumptions rather than assuming a smooth growth trajectory. On smart money, selective Guru buying from high-conviction value managers is a positive signal, but broad institutional participation remains low and insider selling warrants attention. Taken together, the StokTok score of 56 out of 100 reflects a business with genuine asset quality and disciplined management, trading at a price that is not obviously cheap or obviously expensive, which, in our view, justifies the hold signal. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That is the deep dive on ConocoPhillips. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.